to the week ahead with me, Fiona Cincotta, Senior Market Analyst at City Index. And we're looking ahead to the week beginning the 2nd of March. Yes, that's right. We're heading into March already. So just going to push forward here so you can have a quick read of the risk warning and pop myself on mute whilst you do this. Okay, so let's just have a quick crack on now with what is going on next week. But before we get there, let's just take a quick look at what's been happening this week and remind ourselves. So we've basically seen US equities have fallen across the week, fallen around 1%. And that's as they've sort of investors have assessed the uncertainty surrounding Trump's global trade tariffs at the start of the week. And then there's been sort of uncertainty surrounding AI once more at the end of the week, even though we've seen Nvidia post better than expected results, beating forecasts for both earnings and revenue for a 14th straight quarter. So, I mean, the market mood towards AI has been a little bit almost volatile. You know, we've had these worries about the software sector being hit. Then this week we saw those concerns actually steady and calm after an Anthropic investors analysts meeting, agency meeting. And then we've seen those AI fears once again ramp up again, even though we saw those upbeat numbers from Nvidia. So the market's really trying to assess here who are going to be the winners, who are the users from AI, and what the disruption could be, and who's going to benefit. And with that's obviously going to be a process that the market's going through, and also when they're trying to assess timings as to how quick these impacts could take place, and this is affecting obviously valuations. So this is the Nasdaq that we're looking at. I mean, it's fallen away from that sort of those highs that we saw above the 26,200. Still trading broadly in a familiar pattern. We're back above this level here, which is pretty key, but we're just testing it around the 4,700. Now, if we do get a break below that level, and particularly a close below that level, that's going to expose the 200 SMA, and perhaps more importantly, this level here, the 24,000 level. So this support zone, which has come into focus on quite a few occasions now, will be key. And if we get a break below that, then we can expect to see a steeper sell-off going forward. Now, just having a look here at the S&P 500 as well, just to get an idea of where we are, what's been going on. Again, we can see very much in this holding pattern, the broad trade has not moved much. We're not trading at record highs, but we're not moving below this key level here, which is the 6,800. So very much in range. And there doesn't seem to be anything that's really pushing those prices out of range at the moment. So what we'll be looking at next week is whether these indices can move out of range, and I think there seems to be sort of little real reason that they would. I mean, we'll have a look at what's on the economic calendar, but as far as themes are concerned, I mean, it would take a little bit of quite a big shock in order to get this out of range at the moment, if we think about what we've seen so far, and that it hasn't really taken the holding pattern, or hasn't managed to break down that holding pattern. Just as far as the US dollar is concerned, let's just have a look there. I think we are seeing the dollar trade very much again in a holding pattern as it waits its next catalyst. It's very much trading in an ascending triangle there. That's also capped by the 50 SMA. So we're going to be watching to see whether that level can be breached or not. And there certainly is plenty to be watching for next week as far as economic calendar is concerned, on the Monday we've got, oh sorry, let's just talk about what we've got over this weekend. We've got the oil OPEC meeting this weekend. This is the oil chart. Oil had an interesting week. It was actually falling for the past 6 days, but it has rallied on Friday up around 2.5%. And that's with the focus has been very much on the US, Iran, and that's likely to remain the case. We're going to see that US, Iran nuclear talks, they took place yesterday in Geneva, and they will be taking place again in Vienna next week on the hopes of, or the Trump administration is very much pushing for a deal, has a big military presence in the Middle East as well, probably intimidation tactics, but Trump has threatened that a deal needs to be reached within 10-15 days. This was at the end of last week, and otherwise there will be bad consequences. So exactly what that means, we don't know, but with the strong military presence, we imagine that it could be in conflict. Now, obviously, this means that the risk premium on oil is elevated, and that is the backdrop heading into this weekend, where we've got the OPEC Plus meeting, where 8 members of the OPEC Plus will be joining to decide whether to increase output. Expectations are for, after 3 months of pause, that that output will be increased by 137,000 barrels a day. Now, the fact that we've got this sort of like increased price does actually, and a higher risk premium on oil does give the OPEC Plus cover to do this. So that's something to be looking out for as a driver for oil as we open the trading on Monday. Other thing that we do have on Monday is also the US ISM manufacturing PMI, which will be in focus. That's, you know, I think it's very much in focus, the ISM PMI and the manufacturing PMI, given the focus of Trump very much on manufacturing and bringing manufacturing back to the US. Now, expectations, well, if we're just going to use the S&P 500, sorry, the S&P manufacturing PMI as a sort of a backdrop, as a point of comparison, then that did actually fall in February to 51.2, down from 52.4 in January. And that was dropping to a 7-month low, sort of suggesting a softening of demand. Output growth eased to its weakest since July, and employment growth almost stalled as well. So not necessarily favorable signs as far as the manufacturing is concerned. Input costs also remain elevated, with output inflation input costs remain elevated, but output price inflation moderated to a 14-month low. Now, this is the Dow Jones. As we can see, it's actually holding up much better than the NASDAQ. Obviously, the lack of tech stocks in the Dow Jones has been offering support, and has also benefited from that rotation away from growth into cyclical and value. Just as far as levels to be watching, key level 48,700, tested it today. This is a level that's been in focus over the past month or so, up and since the start of the year. In fact, we do get a break below there. We've got the RSI favoring the sellers. We're below the 50 SMA, so you know, there is a potential for this to start rolling over. Then we've got 48,300. That's the lows that we saw on at the beginning of January, and beginning of February and mid-January. And then below here, we've got this level to be watching out for, which is the 2026 low, which is 47,840. So that's what to be watching out for as far as the Dow is concerned. Just sort of looking elsewhere in the calendar, you've got UK spring statement is on Tuesday. UK spring statement, not expected to be a big event at all. In fact, quite the opposite, expected to be very much a non-event, given that we only seem to be just getting over Chancellor Rachel Reeves's budget from November. I mean, it was a late November budget, but it does feel that we're still talking about that and we're heading into the spring statement. So I'm not really expecting it necessarily to be very market moving. This is the pound. I think the pound generally is under a little bit of pressure, particularly against the euro, but also against the US dollar. And that is because we've got this sort of political weakness as far as Keir Starmer's concerns over his ability to hold on to power. After we saw a by-election this week, which was a stronghold for Labour, which they've had for over a century, and they lost that to the Green Party. Also, Bank of England are expected to cut rates in the March meeting, also going to keep the pound under pressure. Key level to watch here is the 200 SMA at 134.40. If we get a break below that, then we're going to test that 134.40, the 134 level, and then you've got the 133.50 level. So they're going to be levels to watch on the downside, but that 200 SMA, that's going to be the key support right now. On the upside, we've got this sort of support zone, a resistance zone, so around the 135.40 level up to 136, which buyers would need to get above. That's also got the 50 SMA in there in order to be showing any signs of strength. We do also have the Eurozone. We've also got Eurozone inflation data, which will be coming throughout on Tuesday. Now, Eurozone inflation ticked down to 1.7% in January, down from 2% in December, and that's obviously below the ECB's 2% target level. Inflation, ECB is not expected to move on rates anytime soon. We've said ECB Christine Lagarde is Christine Lagarde is ECB President Christine Lagarde has said that she's happy that that inflation and policy are in a good place. And so that means that we don't really expect this data to really have too much of an impact on the euro necessarily. So that's, we've also got the minutes to the ECB meeting this week, but again, this is not expected to be much of an event, given that there really are no surprises expected from the ECB as far as rates are concerned. So what else are we going to be watching? I think a good one to be watching is Australian GDP data. Now, this is interesting because of the strength that we have seen in the Aussie, and we're expected to see a rebound in growth in Australia in this quarter to 0.9%. Taking annual growth to 2.4%, and this comes after slight weakness in Q3 where growth was a bit softer at 0.4%. Basically, high frequency indicators have been suggesting that household spending, capital growth, etc. remain strong, and this is going to be slightly offset by sort of downside risks, which are to construction. There has been a slight fall in construction and also public infrastructure. But overall, expect to see solid growth, which comes hand in hand with a tick up in inflation, which would support the view that the RBI could be hiking interest rates further. Other areas to watch, and I mean, this is going to be the non-farm US non-farm payroll, which is the big one that we will be watching next week. Now, obviously, this comes after we saw the January jobs report was actually much stronger than expected, and that came in showing that we saw, what did we see, 130,000 January jobs created. Unemployment unexpectedly fell to 4.3%. This time round, expectations are for jobs growth of around 70 to 90,000, and also we could see unemployment edge a little bit higher. That could be because we saw some volatility in the household survey after January's surge in employment. So we just need to sort of keep an eye on that unemployment rate. If we look at lead indicators, obviously next week we've got the ADP report, we've got the jobs components of the ISM services and manufacturing, and just so far jobless claims have also sort of shown us that they've been relatively steady over the comparable survey period. So continuing claims just rose slightly. As far as what all this could mean for the policy, the Federal Reserve, I think, is showing that it is a little bit more hawkish than what the market has been expecting. The minutes to the FOMC meeting the other week were more hawkish than expected. So there is definitely some concern as far as cutting interest rates further without sort of signs of inflation cooling, especially if we're seeing a stabilization or a potential improvement in the jobs picture, because it's been the jobs weakness and the jobs that's been what's driving these rate cuts. And if we're seeing that actually that weakness is now steadying, then it does remove the some impetus to be cutting rates further. So this is the US dollar, Japanese yen, very much in focus as well, because obviously there's been quite a lot going on as far as the yen is concerned, and also with Japanese government bond yields. So this is going to be a good one to watch. Now, if we've seen this sort of really sharp recovery in the US dollar, sharp weakening in the yen, just testing this 50 SMA and this falling trend line here. So if we do get stronger than expected non-farm payroll results, then we could be looking up towards a test of this 157.78 on the upside, in order to create a higher high. On the downside, if we get weakness there and we get sort of steadying in the yen because of some sort of confirmations or concerns, that those concerns of the Bank of Japan not moving with rate hikes eases, then we'll be looking at downside support here of around the 154.50 as a level to be watching. So that is everything from me. I hope you've enjoyed it, and I look forward to seeing you again next week.